Hello, Jive Traders! Before we dive in, let me share my screen and walk you through my real options portfolio as I do every month for full transparency. You will see the full history, including the huge drawdown during the April's tariff crash. And if you've seen my earlier video, you already know what went wrong. I closed my Blackstone hedge too early and I didn't stick to my own trading plan. That plan includes a very specific Black Swan hedge structure, and everyone who followed it came through that event untouched, but not me. That's why I built the hedge the way I did. Now, despite that, my 1 year performance is still at plus 28% compared to about plus 12% for SPY. But this is important, that figure compares to a market that also crashed in August last year, so it isn't the full picture. Year to date, my portfolio is still in recovery mode, and yes, part of the reason the recovery is slow is because of one key adjustments I made. I'm holding a negative SPY beta weighted delta. Alright, let's talk about beta weighted delta. What it actually does for you as a trader. So, if you've been trading for a while, you know delta measures directional exposure. But if you are managing a portfolio, raw delta alone doesn't give you the full picture. So, let me show you the concept. Beta tells you how a stock tends to move compared to S&P 500. For instance, a beta of 1 means it moves with the market. Beta of 2 moves twice as much. Beta zero point 0.5 less sensitive. Beta of minus zero point 0.2 moves opposite. Now, beta weighted delta just translates everything into SPY terms. So instead of asking how much will this position move if the stock moves $1, you're asking if SPY moves $1, what happens to my whole portfolio? That's the number I care about. This is one number, it shows directional bias, and it's portfolio wide. Now, let's say you are long 50 deltas in a tech ETF like QQQ and short 50 deltas in utilities, for instance, XLE ETF. On paper, you are flat, but the tech position has a beta of 1.6 and the utility ETF only, let's say, 0.3. When you beta weight those deltas, you are still net long the market. This is how traders unknowingly take on market risk. They are looking at deltas, but they are not adjusting for correlation. Beta weighting removes that guesswork and it shows you true exposure. That kind that actually affects your daily PNL. And here's how I use it. Um, I'm usually monitor my beta weighted delta to SPY on a daily basis. For instance, if it's let's say plus 400 and I want to reduce exposure, I can sell 400 SPY deltas using futures, options, or even ETF itself. And this lets me stay mechanical. I don't have to guess what my portfolio is doing because I can measure it and I can manage it. Now, more interesting part, let me show you a snapshot from my own portfolio. You will notice I'm holding a negative beta weighted delta right now, which means if SPY moves up $1, my portfolio is expected to lose money. But is it true? Why would I be okay with that? It's because this portfolio is theta positive. It's built around high probability short premium trades. I'm sharing trade ideas very often in the post tab for free. But the core idea here is that my theta, my theta decay from options exceeds my delta. So even if the market greens higher, my time decay more than offsets the directional exposure. I will say it again. My theta, which is time decay, exceeds negative impact of my deltas. So even if the market greens higher, my time decay more than offsets the directional exposure. And if we get a pullback, that short delta starts working for me while theta keeps doing its job underneath. So what we are looking at is a short volatility asymmetric theta driven portfolio, which is structured to collect profits in quiet market but capitalize even more on pullbacks. Beta weighted delta is what gives me this confidence to run this type of portfolio because I can quantify my risk precisely without guessing. So to wrap this up, if you are trading more than one position or managing a real options portfolio, beta weighted deltas is non-negotiable. It tells you where you stand in market terms. It shows you if you are leaning long or short. It gives you a clean way to hedge or adjust your position. Uh, and if this clarified something for you, give it a like, drop your question below, and subscribe to my channel if you want more real world options logic and examples like that. See you in the next one.